Imagine looking at your monthly income statement and seeing a massive $35,000 net profit. You're ecstatic. By all traditional metrics, the business is thriving, but then the mail arrives, you're slapped with a severe tax warning, and when you log into your bank account, the balance is zero. Statistical data shows that over 90% of business failures are tied to a specific operational crisis. The company simply ran out of cash. Accounting rules define strictly as a financial calculation. It is the revenue you've earned minus the expenses you've incurred over a set period. Cash flow describes a completely different reality. The actual physical currency moving in and out of your business bank account at any given moment. Confusing these two metrics creates a blind spot where a business can look healthy on an income statement while its bank account edges closer to zero. To see how this happens, we must look at two simultaneous views. On the left is your paper reality. On the right, your bank reality, your actual checking account. When you close a $50,000 sale, standard accounting rules record a $50,000 positive entry on paper reality immediately. But on standard 60-day credit terms, zero actual cash hits your account. Your bank reality sits empty while the clock ticks. By accepting these standard credit terms, you are effectively giving your customer a 2-month interest-free loan. Meanwhile, you still have to fulfill that order today. You pay out $15,000 in salaries, rent, and raw materials. On the paper side, you subtract that $15,000 from your $50,000 in revenue, leaving you with a robust net profit of $35,000. But over on the bank reality side, deducting that same $15,000 from a zero balance pushes your actual cash reserves deeply into the negative. You are now forced to fund immediate daily liabilities while waiting months for your own earned income to arrive. This initial mismatch creates the foundation of the cash trap. The gap widens when a business needs to purchase large assets to grow, like buying a $50,000 delivery truck. Looking at our split ledger, accounting rules require capitalization. Instead of expensing the truck all at once, you spread the cost over 5 years, showing a small $10,000 yearly expense deduction on your paper reality. The cash reality is completely different. The dealer requires the full $50,000 payment up front today. Your paper reality glows green with a high profit margin, while your bank reality flashes red, trapped in severe debt. Despite generating strong sales and massive paper profits, you now have an absolute inability to pay urgent non-negotiable liabilities like your employee payroll or the ATO. This specific lag between recognizing accounting profit and actually collecting cash is exactly how a fundamentally thriving business financially collapses. Relying solely on a profit and loss statement is an outdated survival strategy. You can close this cash gap organically in two ways. First, you can negotiate longer payment terms with your own vendors, keeping cash in your company's accounts for an extra 30 days before paying it out. Second, you can demand immediate electronic payments from your customers to eliminate standard invoicing delays entirely. But in the real world, these tactics often fail with large institutional clients that rigidly mandate 60 or 90-day payment terms if you want their business. When you cannot dictate client payment terms, you can use a working capital solution specifically designed for this scenario. Invoice finance. This tool converts your unpaid pending invoices into immediate liquid cash. It bypasses the standard 60-day waiting period, forming a structural bridge that physically connects your paper reality directly to your bank reality. Invoice finance accelerates access to money you've already earned, providing immediate liquidity without the need for new loans or artificial revenue. Long-term viability is measured in profit, but the ability to pay today's bills and keep the doors open depends entirely on the physical movement of cash through your bank account.